Howdy, Jacob here. Next company on our dividend yield stock screener is Blackstone Minerals. So let's start looking at some of the numbers here. Okay, so first, nearly equivalent market cap and enterprise value at 3.6, $3.7 billion. It's an oil, gas, consumable fuels company. I can only presume that with the demand increasing or decreasing for oil and natural gas, that is going to heavily impact these earnings. Looking high level, though, looks like pretty good return on assets, return on equity, return on invested capital, and they're pretty consistent. So that means they probably don't have a lot of debt, which probably could have seen from the enterprise value being very similar. But yeah, they bought back a heavy amount of debt in 2020 to where on the balance sheet they are just one big property, plant, and equipment asset heavy company. So nothing wrong with that. I mean, from what I'm seeing, I mean they have a 10.8% dividend yield. So it's just one of those companies again that whatever they make in earnings, they are just flooding it right back to their investors, which I mean can be great. I mean, a company like this in the oil and natural gas industry, I feel like reinvesting in themselves is not necessarily the smartest thing to do, and so they might be at the cycle in their life that it just makes the most sense to give all the money back to the investor. Which I mean, it's good for management to know where they are in the cycle and if they are on the I don't want to say last two legs, but I mean, if they know that reinvesting would just be poor for them in case of returns and everything, then again, yeah, it's great to give those extra earnings and cash flow out as dividends, and it looks like to be the case here. So we have about 424 million earnings. They gave out 343, 240. They gave out about 200. So yeah, they're pretty good at giving out all their money as dividends and then saving just a little bit on good years since it's such a cyclical business. I mean, other than 2016, 2017, we're seeing pretty heavy positive earnings between 100 and 400 million dollars roughly. So I feel like I mean, it's at $1.90, paying out 414. I don't necessarily think that is sustainable for the long term, but I mean 200. So let's go make a first assumption here. So even if they cut it in half, though, um, everything else, let's say, stays at the roughly $200 million paid out. That's still a 5.4% dividend yield. So that's still pretty spectacular. Um, when you're just trying to get some money, and then again, there's a chance of price appreciation as well. Um, Here, I don't know how much price appreciation I get, but beside the point. Um, let's keep making some assumptions here. So as for earnings, pretty consistent, dropped heavily 16, but back up 17, 18, 19, dropped it again pretty heavily in 2020 when price of oil fell to negative somehow. Don't really know how that makes sense, but back up to 74. I mean, from where we're at right now, I feel like the price of gas sustaining up here. I don't see it being too sustainable. So, um, but as we can see, it dropped pretty heavily down to 564 million. I think that could be reasonable just on just basic inflation. And if demand goes down a little bit, I think they could easily see 564 million again um, over the next sometime over the next 7 years. And then, yeah, the return on invested capital is high, but this doesn't matter if you are buying back shares or paying a dividend because return on invested capital is the money that you'd reinvest back in the business, and they're not grabbing anything that they earned and throwing it back in the business. They're giving it all to their shareholders, which again, there's a point in their cycle where that makes sense, but it means that a premium is not necessary on the terminal PE, because a premium would only be necessary if they would have the capability of reinvesting at those percents, um, where rather they're just sending it back to the shareholder. So if we assume 0% growth, 10 PE, again, I don't think it deserves anything higher than 10. And their growth potential is just so dependent on price of oil and everything. Margins are crazy though. Jeez. All right, let's assume 40%, 45%. That is insane. Gosh. Share change, really probably just share compensation, I'm guessing, right? 12 mil, 17 mil, 14 mil. Bought back a little bit of shares, but not more than share base. So, we can just do 0.05. That's pretty consistent the last 3 years, so let's do that. And then here we get to a price where it need to drop about 49%, 50% before getting us 15% return with these assumptions. Again, this is a type of business I don't know the ins and outs of everything, and so who knows how realistic these assumptions are. I'm basing it off of what I know about the oil and gas industry in its entirety, and then where I think it'll be in the future, rather than just this general company. Until it gets to a price that looks more attractive to me, there's no need to do more detail, because it's really just wasting time when there's so many other companies that could possibly be better investments at the time. So again, I think it's a fine company to keep in your wheelhouse. But as for me right now, I don't think it's a squealing deal. So, all right, hope everyone has a good rest of the day. Thank you.